over the weekend, Memorial Day weekend, and even in the days beforehand, there were a lot more people on the road than I've seen in a long time. Yes, it's typical of a normal holiday weekend, but are we seeing consumers in the U.S. and around the world demanding more gasoline because things are getting back on track?
Well, that's the key question and the key case for higher oil prices. And the fact itself that it resembles a more normal Memorial weekend is already important. And that's what the data shows. People are back to driving the way they used to, nearly in the US and increasingly in Europe. So we are indeed seeing that pent-up demand, which remains domestic and in those two regions for now. But as we go through the summer, we expect to become even broader and include international flying. And that's ultimately the case, supporting higher oil prices up to $72 for Brent now, but to $80 in our view in coming months.
So Damien, what's the primary driver of this? Is it companies, corporations, governments kind of demanding more fuel because things are getting back going again? Is it a consumer demand at the retail level because of that pent-up travel demand, like you said? And if it's the latter, how sustainable is it? Is it a draw-forward effect? Do people get their travel fix and then just kind of drift back off again to kind of normal-ish conditions?
Yeah, so there are many drivers, right? And I think first and foremost is comfort of people to move around following higher vaccination rates and falling COVID cases. And in case of Europe, it's actually governments allowing you to finally drive again. So, it's just a return somewhat to a more normal lifestyle. It does include some commuting. In the case of the US, going back to school in the fall will actually add another layer of the demand recovery. The second component, beyond just daily lives returning to somewhat more normal mobility, is travel, right? So there is indeed a significant pent-up demand for travel, but it is still, in terms of flying as a best proxy, well below where it used to be. And so when we see this recovery, and it's about 30% recovery in jet flying globally since the trough in March, we think there's a lot more to come. Flying ultimately is still roughly halfway to where it was in 2019, and we may not get all the international travel back. But if you look at airline bookings, for example, travel booking, the summer feels a lot more normal in those DM countries, and that's a big next impulse for oil demand. So we're not overshooting, we're not bringing forward future demand, we're really just starting to normalize to past behaviors, which we broadly think will hold. In fact, when you take into account the increase in consumer income, disposable incomes, and savings, you can actually make a case that this could be a remarkable ramp up in travel going forward.
So Damien, you mentioned starting to normalize. That implies what some would call the early innings, perhaps, of a trend or a game as well. If you really believe that we are in the early stages of a fuel demand recovery, where does that put West Texas Intermediate crude prices? Where does that put Brent crude prices in the next 6 to 12 months?
Higher. We think the demand recovery is definitely top of mind in the oil market. But we think the remaining increase that can take place in the summer is still underappreciated. So, through the winter, we probably were stuck at 95 million barrels per day. And we're there all the way through May. And by that point, it felt like a disappointment, especially with the big surge of cases in India. But just over the last month, global oil demand has increased at least 1.5 million barrels per day. So we're at 96.5. We think we're going to 99 million barrels per day by the end of summer. So that big demand increase will take place in face of still relatively inelastic supply, drawing inventories further, pushing prices higher. Our forecast for Brent for this summer is $80, and for WTI, $77.50. So, more than 10% above current prices. What's important to finally keep in mind is, the case here really is drawing excess inventories. And once physical markets are tight, as we've learned already this year in some key markets like steel, prices actually can overshoot to the upside. So I think it's really this big draw on inventories that's demand-led. That's the key driver to where we are and where we're heading in terms of oil prices.
Shepard Smith here. Thanks for watching CNBC on YouTube.